Hello everyone, welcome to our discussion about how we evaluate performance in an organization that has large organization that has many different divisions or departments and things like that. So that we're going to learn some formulas, we're going to learn some things about principles that go into how those are calculated so that we can evaluate performance. This is chapter 5 in your textbook. So first of all, let's discuss the idea of centralization versus decentralization. And this is really an idea if you've got a large organization with that separate departments or divisions, who should make decisions? Where is the decision-making power? And when we say that, we don't mean that all decisions have to be made one place or another. Some can be shared and things like that. There's some combination between being centralized or decentralized in almost every organization. Okay, so if you're arguing for decentralization, that means that the decisions are made by those in charge at the individual divisions, even though they may be far away from headquarters, if you will. Centralized organizations or centralized decision making is done at headquarters, regardless of how many different locations we might have. So those closest to the action and can respond faster, if you think that that's the best people to make the decision or that a particular decision, then that argues for it to be decentralized, meaning someone that is actually interacting with the customer. If you want to give them the power to respond to the customer complaint or concern or request, then you have decentralized that decision making in order to make the person closest to that action able to respond. They don't have to say, "I have to check with my with the headquarters. I can request that and I'll get back to you." That's the kind of thing that sometimes can be very frustrating for a customer. And so giving that to decentralizing those decisions is helpful in getting us close to the action. If it is someone that's needs specialized expertise, then we're talking more decentralized. Okay, but if you want to have the person making the decision have a greater vision for the overall strategy of the company, then maybe that argues for having it centralized, because someone who is just in the trenches with their particular part of the business may not see how that relates to all of the rest of the business, and therefore may make decisions without that understanding of the overall strategy. Where should we get things done? Some functions are better done centralized at the headquarters because it involves a large volume of the same types of transactions, for instance, and therefore it benefits from economies of scale, which means we can use technology and not be able to leverage our technology and utilize it to the best of our ability. Are they specialized that headquarters may not understand? Meaning, then it should be more decentralized. So, and you've probably seen this at work someplace, and probably if you've had enough experience, if you've worked with a large organization, not just a small business. Okay, accounts payable and payroll tend to be centralized. Okay, and that has its advantages in that they can become very efficient in processing hours and things like that. and making sure that everybody gets paid and taking advantage of discounts, especially if they're buying stuff and buying it in bulk. They can do so and get larger discounts for buying large volumes of things. So those things are often centralized. But you've probably come across someone complaining that headquarters doesn't understand or messes this up because they've automated, because they've got it all, doing it the same way for the whole organization in order to get efficient. They also, there's individual items or unique situations that they screw up, okay, and that can be frustrating for those on the front lines sometimes. So, customer specifications, direct with customers, the unique ideas of your particular area can be frustrating because headquarters doesn't understand what that's like. They haven't seen where you work and things like that. And other times you're just as soon have everything handled by headquarters and not have to worry about it. So if your functions are decentralized, and if you've decided to give decision-making authority to individual department managers or location managers, if they have been given that authority, then we need to have some way to hold them accountable for the results of those decisions. Let's see if they are doing a good job. Because if headquarters does all the decisions, then there's not much reason to hold the manager responsible for anything, because they don't get responsible for, they're not responsible for much. But as soon as you delegate and give them that opportunity to make those decisions, then the question is how are they doing with that? And we evaluate based on what level of authority we give them. And while we're going to give you 3 different levels, again, there's combinations or subsets of this. This is not the only ways that you can look at this. So if one is a cost center where the managers can control only costs but have very little authority over what is sold, what the pricing of the sales are, that sort of thing. Profit center, the manager can control the costs, but also revenues. And so they have a little more pricing power. They have the ability to make decisions with regard to specials or promotions, so that they influence revenues. If all those specials or things are done at headquarters, then that means that they're more acting like a cost center. And then an investment center, managers can control not only the costs and revenues, but also have a say in the level of assets that you buy, so they can make decisions about whether to invest in new assets, to add to the machinery, add to the building, things like that. Typically, even if they're given that authority, they have some constraints, meaning they can make the decisions up to a certain dollar amount or something like that. So that it's not full authority, but it does have quite a bit of decision-making authority over assets. So a cost center, with examples of a cost center, manufacturing assembly line, okay? We just need to make so much of our product, okay? Accounting, human resources, payroll, information technology, the behind-the-scenes departments, the service departments as we call them, they provide the business services of the business. They don't sell their product. They don't sell it. They have no revenue source. Payroll people do not sell their services to the rest of the business or to outside customers. They only have control over costs. So we have to use some sort of budget or flexible budget, even better, like we learned in Chapter 4, okay, to evaluate the costs against what this is what we think we should be able to get payroll done and accounting done for, and this is what it actual, to see that we keep it under control and don't get carried away, because it can't be compared against the revenues. So we have to compare it against some sort of plan. Profit centers, though, the manager has the ability to influence the revenue, the pricing, and the costs. So comparing what they sell things for versus what they cost them is a great way to measure that. So net income or operating income divided by the sales, which is the formula we learned for profit margin back in earlier accounting classes, would work well for this. We just have to identify the revenues and costs that go along with this particular department or piece of the business and separate it from the rest of the business. We can just evaluate this particular manager. Now the budgets could still be used. Don't abandon the budget. We could have a budget for the department and compare both the revenues and expenses to what we planned. Okay, this might be the individual retail stores in a chain where you have some authority over this revenue and who to hire and meaning the costs, and some determination of what you buy from in terms of putting it out on the shelves, things like that. Or a restaurant, you could set your own pricing at a restaurant, even if you were part of a chain, based on local conditions. Then you would have that profit center authority, and you could be used. So if you have higher costs in a particular store, even though your menu may be similar across various areas, as you have the particular restaurant, you may set the prices differently based on local conditions. And then your thing is, if you raise the price, it's and can get people to pay that, then you're going to profit margin is going to go up. So that would be a smart move. Okay. Investment centers, we want to expand ourselves from our profit margin. Okay. We want to look at what that compares to the assets, which they also have responsibility for. So we're still going to calculate the profit, but we're going to compare that to assets. All right, so that we have a feel for how well they're making the decisions with regard to investing in assets. So the formulas we use from here on out are pretty much based on evaluating an investment center. And so we're going to talk about calculating segmented net income, and then we're going to use that in three formulas: return on investment, residual income, and economic value added. So segmented net income, okay, so this is just where we get to. This is an intermediate step on our way to getting to the later calculations. When we do this, we're going to have revenues separated out from other segments. We're going to have costs identified for just our particular department, our particular store, our particular outlet. We should probably not consider overhead allocated from headquarters. Back in Accounting 160, we learned that allocated overhead can be distort our decision making on a short-term basis. It can also distort our evaluation of a manager, because the manager doesn't have any control over what is allocated from headquarters. We shouldn't probably worry about the taxes, again, outside of our control. So we should probably use our, just ignore income tax expense. The key is to be able to, in your accounting system, identify which costs belong to each particular segment. And of course, this is the step before we calculate our other calculations that we're going to go to now. So once we have our segmented net income, we take that operating income or that net income, segment income, and compare it to the average operating assets. Divide operating income by average operating assets. And to get an average, you take the beginning of the accounting period, the ending plus the ending of the accounting period, and divide by 2. And that will give us an average that will be sufficient for our needs as far as precision. For calculation in the text in your homework and the problems they give and examples they give, typically they use all assets, but regularly in business, in the real world, when we add up the assets, we ignore cash, okay? Because first of all, cash is usually held by headquarters. Not part of a segment. Second, okay, it's not a very useful asset in terms of being able to generate return. It really is just helps us pay the bills, that sort of thing. So remember, we're looking at the operating income for just our segment, and we're looking at the assets that belong to our segment. What does this manager have control of? What assets are part of this particular segment? So as we consider the assets to use, we definitely want to use property, plant, and equipment as one of our operating assets. All right. So it should be included. The question really is, should we include it at original cost, or now that we have some idea about the calculation of depreciation, should we use net book value, subtract accumulated depreciation when we use that? Because we're just going to add up these assets. Should we take out the depreciation, or should we use what originally paid for it? There's not a set way to do this. Okay, remember this in managerial accounting. We don't have FASB rules to tell us how we should calculate these various evaluation techniques. But once you have identified a way you're going to do it, either include the depreciation or don't, you need to be consistent, comparing one segment to another or one year to the next. Or you're not going to be able to make valid comparisons. If we were to think about return on investment in a more detailed way, our formula is operating income just for this segment divided by the assets that segment controls, or average operating assets. If we break it into two pieces, operating income divided by sales is a profit margin calculation we've already learned about. That's a formula and we already talked about it even in this presentation. And then sales divided by average operating assets is considered asset turnover. So return on investment could also be stated as profit margin times asset turnover. And why is that valuable? Why is that helpful to think of it in its two pieces? And that's because when we do that, we can say, if I want to increase my return on investment, I've got kind of two main approaches. I can either increase my profit margin by adjusting sales price, finding better ways to get my product to influence cost of goods sold, or expenses, get my expenses lowered in some way. That's going to all impact my profit margin. And that's an important part of return on investment. But you can also impact or work on asset turnover, meaning generate sales faster, okay? Get more volume so that our assets are being more efficient. So a business often is thought of as having either high one or the other of these two things, meaning, like, let me give you an example. Grocery stores have a lot of asset turnover. They sell their inventory quickly, obviously because it's going to spoil, whatever, in many cases, but they don't make a lot of money on each item they sell. They get a very low profit margin on their products they sell, but they sell a lot of them. And so they are very dependent on volume. They need a lot of traffic through their stores. And they rely an awful lot on specials and advertising and things to drive that traffic because they need that asset turnover. A jewelry store doesn't have near as much traffic. Okay, doesn't need as much traffic because it's going to have a higher profit margin. They're going to make a large profit percentage-wise on each item they sell, especially custom jewelry or high-end jewelry pieces. So they're gonna make 70-80% markup on their product. Grocery stores are never going to make more than 10 or 15, maybe 20%. So a jewelry store is going to have lots of assets to display, right? That is going to be very expensive. And so a lot of assets in terms of dollar amount laying around in the store compared to how much their sales are. They may only have 2 or 3 or 4 sales a day. Grocery store, you can't imagine only having 2 or 3 or 4 sales per day, right? They need hundreds a day in order to make, and they can have the same return on investment, but they tend to focus on either profit margin or asset turnover as being the most important. Now, no matter what calculation we do, if we are looking at a single calculation to evaluate the performance of a manager, then there's going to be drawbacks. Ideally, there would be a range of things that would be measured to allow us to evaluate the performance of a manager. So we don't expect return on investment to be a perfect measure of how well a manager is doing, but it's an important one, okay? And it's a percentage, and sometimes we might utilize it in the following way. We might say if you get to a return on investment over a certain number, 10% as example, then you get a bonus. If you are able to increase your return on investment from last year, okay, then you get a bonus. So what happens? Managers become very anxious to improve return on investments. If this is the only way you get that, they may even be tempted to manipulate numbers in order to get to that goal, especially if their bonus is a substantial amount of their compensation. Okay? They may, and this isn't necessarily unethical, they may reject things with a questionable ROI or even with a good ROI, return on investment, but because it's less than last year, they may reject it. Even though it could benefit the company as a whole, it won't help them reach their goal of getting that bonus. And so we run into this decentralization challenge, and that is that a manager in this situation may make a decision that makes their part of the company better and make them look better for bonus purposes or just to get an attaboy, that don't help the company as a whole. It may not be the best decision for the whole company. And they may do that knowing that it's not, and they may do that without knowing. And so therefore can't really be held responsible for it. But nevertheless, they are going to do what is in they're going to create the best return on investment. And that may not always, for their particular segment, that may not be what will create the best return on investment for the whole company. Residual income is a second measure that tries to overcome the drawbacks of ROI in terms of rejecting things that have good returns but not good enough to meet our criteria. So this calculates a dollar amount, not a percentage like we did with return on investment. And if your residual income is positive, that's an increase in dollars to the company and therefore is a good thing. So you would reward having a positive residual income for the manager. To calculate residual income, you take your operating income for just your segment, right? So back to that calculation we learned about a couple of slides ago. And then you subtract and make sure that this calculation's in parentheses, percentage cost of capital times your average operating assets. So you see we're using some of the same numbers as we did before. Average operating assets is familiar to us, but this time we're multiplying it by this cost of capital. This cost of capital we introduced in accounting 160 is the cost to get our assets. It has some multiple components. We're not going to calculate the cost of capital. It's going to be given to us, but it's basically what it takes to get our assets. The idea is if your assets make more than it costs you to get those assets, then you're in good shape. You're making residual income. You have income left over after you pay for your assets, if you will. So every project or every decision, every plan that at least covers a cost, so at least the plan shows it will cover the costs. The cost of capital will be accepted by the manager because that would increase our residual income. The drawback of residual income is it's harder to compare one segment to another. Percentages make for good comparisons between two segments. Residual income doesn't do that as well, but it does a better job of helping the manager make decisions that are in line with what's best for the whole company. Now, some people would say this economic value added is the very best way to evaluate a manager. It was developed by some consultants several years ago, as a way of kind of improving basically the end-all be-all of this formula. It is very, very similar to residual income. We simply take the operating income and we make some adjustments. And then subtract the cost of capital times the average operating assets. The average operating assets have also had some adjustments to them. So the difference is just these adjustments. You're going to adjust operating income and you're going to adjust average operating assets. These adjustments because it was done by a private company, consulting firm, is a secret. Nobody, somebody knows what all the adjustments are, but they are under oath or whatever, sworn to secrecy, that they won't tell all of the ins and outs of that. So speculation or thoughts about what the adjustments are, some things have leaked out, type of thing, typically include treating research and development as an asset instead of an expense. So we know under U.S. GAAP that we treat research and development as an expense. These consultants are saying it really should be an asset instead. And if you put it as an asset instead of an expense, then you amortize it over 3 years or something like that. Marketing costs, advertising is also considered an asset instead of an expense. So you see that they disagree with what U.S. GAAP typically does with these costs. Okay. They also are going to take out assets that can be obtained without interest expense. Typically, that results in not counting the amount of accounts payable. So any of your once you add up your operating assets, you subtract out the accounts payable because you didn't have to pay any interest when you borrowed that money. These are just three. There's most likely a whole long list of these adjustments. Those are probably the ones that are most important, the ones that you'll see. They'll be given to you, any homework that you might be asked for. Okay, and it's usually going to make the operating income increase under this scenario, and could make the assets higher or lower depending on where you are and how much you spend on these various research and development, marketing sort of things.